Is a Roth IRA or a traditional IRA better for you? Well, in this video, we're going to discuss the system that we walk through so you can help answer that question. We're going to discuss the difference between a Roth and a traditional IRA, the benefits of each one, and then also help you determine which one of these accounts is right for you. I'm Kyle Kuyat, a certified financial planner and co-founder of Defining Wealth. Also, down in the description below, we've included a downloadable PDF that you can use to help you answer this question for yourself. Let's get right on into it. Hello and welcome to the Defining Wealth podcast. I'm Kyle Kuyat, as always, joined by my co-host, Jake. Jake, welcome.
Thanks for having me yet again. Still tolerating me after all this time.
We're stuck at the hip. So, until we cancel the show, you're going to be here forever unless we get canceled. So hopefully not. In our episode today, we are going to talk about the key differences between a Roth IRA versus a traditional or a pre-tax IRA, or just, Roth in general versus pre-tax. And there's a lot of things to consider. Jake, we get this question almost every single day, it seems like, at least from somebody either reaching out or with a current client that's evaluating their situation. We're helping them go through it. But before we can understand what's best for you, we need to first understand actually how both of these vehicles work. And then we can determine from there the necessary steps. So Jake, you kick us off today. Let's talk about some of the key differences as to what they are, and then we can get into the different benefits they offer. And then so people can decide what's best for them in their plan.
Yeah. Of course. And I think a lot of folks have questions about this. Our clients ask us these questions all the time, especially when they're newer and we're kind of going through their plan, getting them set up and telling them why we're doing certain things. It's like, well, what's the difference here between the Roth IRA and my traditional IRA? There are a lot of differences in how these accounts actually work, and we ought to know why. The first thing you might ask is like, how are contributions made? What does that look like? What are the differences there? So in a Roth IRA, all of your contributions are going to be after tax. So it's money you've already been taxed on from your paycheck. That is the first key difference there, because the traditional IRA, you get a tax deduction. So if you have an income, you can contribute to either one of these accounts. If you put $7,000 into one of these accounts, it's going to be treated differently. The Roth IRA, you will not get a tax deduction for, and the traditional IRA, you will.
Right. That's true. And I think that's obviously one of the key differences in there. We'll dive into the different benefits and why one may make sense, not just long-term, but even in a certain year, but let's talk about the growth, right? How are these accounts going to grow, and why is that even important?
The growth is one way in which they are very similar, right? So as you grow these accounts over time, they should be invested into the market, right? As they grow, they're both going to grow without incurring taxes to you throughout your investment journey. So that's different than a brokerage account, which is totally separate. You can get taxed on as it grows throughout the year, throughout, the decades as it grows, hopefully long term. Both of these accounts are going to act similarly in the sense that there's going to be no tax incurred, even as income pays out of the funds that you own, as you rebalance or liquidate certain funds to move them into a different investment within the account. There's going to be no taxability to these as they grow for the long run. The difference really is how are those treated on distribution, which we will get to. And that is the key difference between these two accounts.
One of the things, there are obviously some differences in these, but they are both retirement accounts. The other thing too is, as far as how much money you can contribute into them, that's new money, it's the same. So for 2024, it's $7,000 across the board. If you are 50 or older, there's a catch-up provision, so you can actually contribute $8,000 versus $7,000. But Jake, let's talk a little bit about eligibility, right? I mean, there are some key differences here as to who can actually contribute new money into one of these accounts. Let's talk about who can and who can't.
Yeah, and this is a unique and somewhat confusing and difficult problem to figure out, because there's a lot of different rules when it comes to how can I put money into this account or that account. With the Roth IRA, it's going to be dependent on your income. You have to have earned income, first of all, to put money into a Roth IRA. And then there's a phase out. It starts at about $146,000 for a single person. If for all you married folks out there, it starts at $230,000. You're going to have to actually stop making contributions altogether. If you're single, that number is $161,000. If you're married, it's $240,000. So for the Roth IRA, again, those are your parameters. If you're single, phase out at 146, ends at 161. If you're married, it phases out at 230 and it ends at 240. So obviously there is a little bit of an advantage for you married folks out there. You can make more money as a household and still be eligible for these Roth IRAs. The traditional IRA, it's going to be a lot messier. There's just a lot of different rules about when can you contribute, and really more importantly, when is it deductible, right? And that's one of the main differences between these accounts. Remember, when the money goes into the Roth, it's not deductible. When you put money into a traditional IRA, it is deductible unless some of these things are true. So let's start with just kind of basic level. Again, you or your spouse needs to have earned income to contribute to an IRA. The difference here is you can actually have spousal traditional IRA. So if your spouse does not have earned income, you can create one for them and still contribute from your income as the earning spouse and just drop it into their IRA as well. The deductibility of those contributions is going to depend. There's a lot of things that work into that. And really, truthfully, what it comes down to is Uncle Sam wants you to pay taxes on something. And so they're going to give you some benefits for contributing to these traditional IRAs, but to a certain extent. If you are single and you have a retirement plan through work, you can make up to $77,000 and still make contributions that are deductible. After that, you start phasing out. Once you get to $87,000 as a single person, if you have a retirement plan through your employer, you no longer can deduct your contributions to the traditional IRA. If you are single and you do not have a retirement plan through work, there's no limit to what you can deduct. You can put in that $7,000 no matter what your income is and take the tax deduction if you do not have an employer plan at work. Again, this is a little bit more convoluted than the Roth IRA. And as we kind of move on to the married, if you're filing jointly as a married person, then you can make up to 123, and then 143,000 is where you phase out there. If neither of you have a retirement plan, there's no limit. You can make as much as you want to, need to, as much as you are making, you can still take that deduction if you don't have an employer plan you're eligible for. That's a lot of detail on the traditional IRA side. It's really, can I contribute? The answer is yes. Are the contributions deductible or not? That answer is it depends.
Right. And that's why that bluntly is our answer quite often, is it does depend, because there are so many moving parts on some of these accounts, and it really simply does depend on your situation. We're going to talk a little bit more about some of the benefits of these, but another area where it really does depend is on taking money out and withdrawals. Kind of the reverse here, though. Rather than the traditional IRA having some more intricacies, the Roth IRA, I think some people just don't understand. How can I take money out? Where are their penalties? Where are they not? Let's talk about some of the things that people need to know that's important when it comes to taking money out of both of these accounts, Jake.
Yeah, really good question. I'm going to start this side on the traditional IRA side because it's simpler. With the traditional IRA, you can take money out after you've become 59 and a half years old, basically. You can take money out without incurring any penalties whatsoever. Again, remember, when you put money into this traditional IRA, you got a tax deduction, more likely than not. If you didn't, then there's all sorts of other strategies we can employ to take care of that. But if you got the tax deduction, everything coming out of there is going to be income taxable. So whatever your income tax bracket is at the time, you're going to pay ordinary income taxes on this distribution. If it's before 59 and a half, you're going to pay a 10% penalty. If it's after 59 and a half, you won't. And it's really quite that simple. There are exceptions. I don't think we need to get into all those exceptions, but things like education, some home, like first-time home buyer exception, those things can apply. But again, I would consult a professional before you get into those types of exceptions. With the Roth IRA, it's a little bit more complicated, almost like with the traditional when you're making contributions. With a Roth, you can always take out your contributions tax-free without penalties, even before 59 and a half. Those are contributions you made after tax. You did not get a tax deduction for them. They are your basis in this account, and you can take those out. There is a 5-year rule that I'll get to in a moment, but if you are growing this account for the long term and you have it invested and there are earnings in the account, those will come out and be taxed if you take it before 59 and a half, just the earnings. So if you put $100 in and it grows to 150, you're going to pay taxes on the earnings of that account if you take it out before 59 and a half. If you are over 59 and a half, so you're in retirement age, you're not going to owe anything on the earnings as well as the basis, what you put in. Again, that part's never taxed. But even after 59 and a half, you'll never pay taxes on the earnings either. The complication here is that 5-year rule. So the 5-year rule is a little bit more convoluted. If you open a Roth IRA, you have to wait 5 years to take out earnings without paying taxes on them. So even if you opened a Roth IRA right before retirement age, you are 58 and you're trying to take distributions at 61, 62 because now you're retired and I need income, you're going to have to pay taxes on the growth in that account because you didn't wait 5 years. This is, Kyle, a good reason why we always open Roth IRAs for our clients, whether they're really ready to save a lot into a Roth IRA or not. We make sure that they have it open and we at least deposit some amount of money in there, start that 5-year clock. And then when you get to retirement, it's something you literally don't have to worry about at all because it's been 30 years.
Yeah, no, absolutely. And again, this comes into perspective a lot for planning, especially for our high income earners, that when we start getting into what's called backdoor Roth strategies, it's important that we do that because otherwise, again, those doors close and it's a little bit harder to do a backdoor when you don't even open up the door in the first place. So for lack of a better term, a lot of doors, a lot of moving parts, but we try to make it as simple as possible. So let's hit on one last thing before we start diving into the meat and potatoes and really the fun part of this conversation. We need to also understand required minimum distributions or RMDs on these accounts. Where do they apply? Where do they not?
Right. And so for a lot of our listeners, this may seem really far in the future, and that's okay. But just know, if you are working with us, we are thinking about this way ahead. For the Roth IRA, you do not have to take RMDs in retirement. Now, RMDs are required minimum distributions. That is an amount that the IRS forces you to take out so that you pay taxes on that money after getting a pre-tax deduction on a traditional IRA or even a 401k plan while you're working. With the traditional IRA, when you turn 73, and this number is going to go up, by the way, but when you turn 73 right now with pre-tax money, you are forced to take a percentage of that money out every year, whether you like it or not, whether it's needed or not. You still have to take money out and pay taxes on it. The Roth IRA avoids that entirely. You've already paid taxes on this money. I know we keep hitting on that, but you've already paid taxes on this money. It's grown tax-free and you'll take it out tax-free. And you are not forced to take money out of these Roth IRAs under the current tax code.
That's all spot on, Jake. And I think, again, that's the meat and potatoes that we certainly do need to understand before we start to talk about the benefits and really where it's best for you specifically, because there's probably one of you listening on here where a traditional IRA is far better, is the far better option. There's probably some of you on here where a Roth IRA is the far better option. And there's probably the majority of you where, hey, maybe it's a combination of the two. Maybe it's one or the other. It's kind of on the fence. I don't really know. So now we're going to talk a little bit more about, I call the fun, sexy part about this, really the question tree that we walk through. And as I mentioned earlier, we do have a sheet that's available for you that you can see kind of the what and also the why and the how behind we make these decisions for our clients and help them make these decisions for themselves. So Jake, let's talk about some of those. First and foremost, let's talk about some of the tax-free growth and withdrawals.
Of course. So really now we're moving into the benefits of these different types of accounts. And it'll be no secret to everyone who's watched our first couple episodes, we really love Roth IRAs. They're incredibly powerful savings vehicles. One of the benefits here is going to be, again, that tax-free growth and withdrawals. The IRA will grow tax deferred and you'll end up paying income taxes on it later down the road. But don't underestimate the power of that tax deferral. Just because we really like Roth IRAs and the tax-free withdrawals does not mean that there's not a place for traditional. The tax deferral is a big deal and it allows you to accumulate a ton of wealth without paying a ton of taxes along the way. The Roth IRA's benefit, however, is when you take that money out, it's tax-free. You're not paying income taxes in retirement on any money that you take out of a Roth IRA. And that's going to have a lot of trickle-down effects of what your tax situation looks like and how flexible your retirement looks. So the first benefit, again, of these Roth IRAs is you don't pay taxes in retirement. You grew the account tax deferred and you take it out tax free.
Yeah. And we talked about this second benefit in our last episode. We covered that in detail. So if you haven't listened to that yet, make sure you go back and listen to it. But just to hit on it super high level right now, we also want to make sure we have diversification and, for better or for worse, control over our tax situation and tax benefits, not just in retirement, but also today. As we mentioned before, if we are contributing to a traditional IRA, depending on your situation, that can give you a tax benefit today because it is a tax deduction. However, in the future, if we ask clients or we ask folks, where do you think tax rates are going to be today versus when you're in retirement? More often than not, people answer they think that they're going to go up, or at least they aren't going to go down. So again, if we have this large bucket of traditional IRA money that's never been taxed, and hey, it's grown tax deferred, but at the same time, I have to pay taxes on that larger amount moving forward. That's something also that you do want to consider. Jake, let's also, I think, kind of bullet point 2 and 3 for us here. You know, when it comes to the diversification of taxes in retirement, also control of our tax brackets, what else is important for people to comprehend and think about whenever they're making this decision?
When we think about diversification of tax treatment in retirement or control over your tax brackets, what we're really talking about is, can you make strategic decisions in retirement, or is it just kind of happening to you? That's really what it boils down to. We want to create a situation, an environment in retirement where we have the ability to take strategic withdrawals and optimize those withdrawals for maximum flexibility, tax efficiency, and control. Like in a situation where we're controlled by the way that we've saved money in the past, when we could have set up a future where we had control over what money is taken out and at what times. So the reason that becomes really, really important is Roth dollars allow you to lower your required minimum distributions. Remember, pre-tax money, when you turn 73, you are forced to take out of those accounts and pay ordinary income tax on it. That can have all sorts of downstream effects, again, like paying taxes on Social Security benefits, whether that's paying taxes at all on Social Security or paying more than you had to. And in addition to that, however much you pay for Medicare, that can change depending on how much you earn as income, which is what those pre-tax withdrawals from a traditional IRA are counted towards. The Roth IRA eliminates all that problem. Whether we have Roth IRA money available to us determines if we pay taxes on Social Security or Medicare premiums, things of that nature, or not. We can really avoid paying either any taxes or substantially more taxes at the very least if we have options in retirement where to take money out of.
Right. And this is why I always hit on it. And I know you do too, Jake. Obviously we do as a firm specifically, but whenever we're talking to folks, it's, hey, it's not just a good investment decision. It's not just, is it a Roth IRA? Is it a traditional IRA? Yeah, it's no big deal. I'll just pick one and move on. No, there's implications here. And again, it's not just a good financial decision today. It needs to be a good financial decision long-term. It needs to be a good tax decision today and long-term, and a good investment decision today and long-term, as well as, you know, many other moving parts. One of the other ones that really sneaks up on people, especially clients that we have that fall into a bucket where they're maybe now starting to inherit money, whether it be from parents, grandparents, et cetera, is, hey, I'm making a lot of money. Our financial situation's getting a little bit more complicated, but we're doing pretty well. And whoa, out of left field. Again, I'm not angry about this, but, you know, mom or dad passed away and they had a lot of money in a traditional IRA. And all of a sudden, that's going to shake up your tax situation quite a bit. So let's talk about maybe the sort of the issues that can come with that and what we've seen with folks that are inheriting this money. But again, if you are maybe the other side of that and planning, doing your estate planning side, you know, maybe to set this up for your kids or your loved ones, you know, how do you most effectively and really tax efficiently pass money on versus leaving money behind to the government?
It's a really good point and undervalued point by most folks, because it's hard to think, first of all, about, you know, one day I'm going to leave this earth and somebody else is going to have this money, or I'm spending all this money and nobody's getting it. But the first case is the one that we're really interested in here. What people need to know about this is there are new tax laws saying you have to distribute an inherited IRA, whether that's Roth or traditional, within 10 years. That would include like a 401k plan as well. So you're not getting out of it if you leave it in a 401k forever. Any retirement funds need to be taken out of those accounts in 10 years for any of your beneficiaries, whether that's 1, 2, 3 different beneficiaries. They got to drain that account, and there's no way around that. So what the difference is for them inheriting this money, or for you, if you're a listener who is inheriting this money and just needs to know what to do, the difference would be pre-tax retirement funds need to be taken out within 10 years. Each of those first 10 years, you need to be taking a required minimum distribution. That's going to be based on life expectancy. That is something that you really ought to talk to a professional about and make sure you're taking out the correct amount. But I will say for that, if you are taking out just 1/10 every single year, you're going to be in the clear. You're going to be fine. And I would suggest that you try to match up those distributions from a pre-tax retirement plan that you've inherited. Split those up so you're not getting smacked in the last year with a huge tax distribution when you really don't want to be paying taxes on a massive amount of pre-tax money. What we typically find, Kyle, and why this is such a big deal, is usually when people inherit these funds from their parents or whomever, they're mid-career. They're in their highest income earning years, and that's where it becomes really challenging to navigate a pre-tax inheritance.
I agree. We've had so many of those conversations with our clients that are doing well for themselves, but mom and dad maybe didn't have a plan properly, and maybe they did. They just didn't really know that this was going to be an issue necessarily. And again, it's not don't hear what I'm not saying. It's not an issue to inherit money. That's normally not a bad thing. However, there are things you can do from a planning perspective. Again, if you are on the other side of that, where it could be the difference of hundreds of thousands of dollars, depending on how much money we're really talking about. So again, is that worth having a conversation with somebody, or at least setting things up initially to maybe avoid some of that? I personally believe so, especially having seen it several times on the other side. But again, it's one of the things you need to at least be aware of going into it, because more often than not, we've had so many folks that they think they're inheriting this big bucket of money. And then all of a sudden we start to peel back the onion on, hey, you're going to pay taxes on this. These are the rules you need to follow to do this. And oh, by the way, it's going to affect your current tax situation. So many things to consider here.
And the difference too, with those Roth IRAs, just to go back to that 10-year time period, you do still need to take the Roth IRA funds out by that 10th year. But because Roth IRAs have no RMDs or required distributions associated with them, that passes on to the beneficiary as well. You can wait until that 10th year. And typically we suggest, unless the beneficiary needs the money, we suggest you wait until that 10th year, because you're still getting that tax-free growth growing without encumberment by taxes on an ongoing basis. So you do want to leave the funds in there if it's a Roth IRA. The traditional IRA, you do need to take out money every year. Make sure it's more than the minimum distribution, and consider matching that up. If you have a low taxable year, take out more that year, even if it's year 2. But if it's, you have a pretty stable job, your income's not really changing, just try to split it up into some buckets there each year, so it's not adversely affecting your tax situation too much.
Right. And our last point really, and again, there's many other things I guess we could go down a rabbit holes on, but just to keep it high level and conceptual so you can make a clear decision without way too much information, is, depending on which bucket you choose, you can also mitigate some legislative or political risk in the future that may change, how tax rates or how these accounts are treated, right? Again, with the Roth IRA, if you are paying taxes today and something drastically happens over the next maybe 5, 10, 15, 20 years, depending on how many years that is between now and the time you retire, you don't really have to worry about it. And it's not like, tax rates are now going to go up to 60%, right? If you already paid taxes on this money, that may be a drastic example, but crazier things have happened. There are things like that can be a reality. It may not be that drastic, but again, the more money you have in these accounts, the larger that situation and change can actually have an impact on you in the future. If it's $10,000 today, may not seem like a big deal. And if it's maybe, $25,000 to $30,000 difference in taxes in the future, may not seem like a big deal. But if you drag that out of retirement and you live a 30 to 35 year retirement, add a couple more zeros in there, and it's like, whoa, I wish I would have talked to somebody 30 years ago about this. So again, many of the things that, you want to consider whenever you're making this decision, obviously, that's why if you see anybody online that's saying you need to do one or the other, just blanket statement, clearly it's an it depends answer. And I hate giving that answer, but it truly does depend. If you want the right answer for you, you need to walk through this question tree either with somebody or by yourself and go through it. Like I mentioned before, we do have all the information we talked about today in an easily digestible format. And again, if there's a part of this that you want to know more about, feel free to ask us down in the comments section below. We're happy to answer any questions you have. And we may even make another additional episode because there are a couple of these key points, maybe like the 5-year rule and some other things that we discussed that probably could warrant a whole episode in themselves. But Jake, is there anything else you want to hit on today before we wrap up?
No, I think we covered pretty much all of it. We really want to make sure that this is made simple and clear for folks. That's why we're providing the document after the fact. And just be aware when you're putting money away for retirement, what kind of account it's going into, how it's going to be taxed, how your future tax situation could look based on that. That's why we do what we do and make sure that people know the answers to those questions.
Well, thank you so much for watching this video. Hopefully today determined whether or not a traditional IRA or a Roth IRA, or maybe even a combination, is better for you in your situation. If you'd like to see more content like this, make sure you go ahead and click subscribe. We'd be happy to answer any questions you have down below, or ping us anytime at definingwealth.com.